Welcome to the Buying Australian Property While Overseas webinar, where we're going to share with you some market insights, tips and tactics from industry leading experts. So today's agenda, we've got speaker introductions, followed by our three topics: Australian expat mortgage financing, buying Australian property, and just general Australian property market update, followed by tax essentials for non-residents. And then lastly, we have our Q&A. Just some general housekeeping. This session will be recorded and the slides will be shared after the webinar. Ask your questions in the chat box section, and we highly encourage you to ask as many questions as you can. And just in the chat box section below, not the Q&A. And if we go over 5-10 minutes, we'll do that to ensure we get through all of them. Okay. So my name is Ben Wong. I'm a co-founder and mortgage broker for Odin Mortgage. We are an Australian mortgage broking company based out of Hong Kong and Singapore. And we deal specifically with Australian expats and overseas residents, people living overseas. Up next, we have Rich Harvey, CEO and buyer's agent of company Propertybuyer. Rich has been a buyer's agent now for over 20 years, and his company Propertybuyer is the most awarded buyer's agent in Australia nationwide. And last but not least, we have John Murphy, principal consultant, from Connole Carlisle Chartered Accountants. He's a highly experienced tax accountant, over 20 years experience, flies to and from Singapore and advising his expatriate clients on tax advice. I'm going to jump straight into expat lending overview. So what is still available for people who are living overseas, holding an Australian passport or PR visa. So you can still borrow up to 80%, up to 90% with lender's mortgage insurance, and that's with Commonwealth Bank of Australia. You can borrow up to 30 years loan term, regardless of age. So you could be a 99-year-old auntie to get a lending up to 30 years, provided you're still working and can provide a positive cash flow. And there's no early repayment penalties in Australia by law. So you could get a mortgage today, win lotto, pay it out tomorrow, and you're not going to get whacked with that 1-2% early repayment penalty like you do in Hong Kong, Singapore. I want to talk about what's been happening in the last 6 months. This was not specific to expats, but just more so everyone in general from a lending perspective. And that is, they've tightened up the banks, that is, they've tightened up the lending criteria on how they assess how much you can borrow. So they've increased the assessment rate. So when you get a mortgage, or they calculate the repayments by not by your actual interest rate, it's by your actual interest rate plus 2.5% buffered, but now they increase that to plus 3%. So that's just increased the repayment, therefore higher expense, less that you can borrow. They've also lowered the debt to income ratio. Not going to explain this one in too much detail, but essentially the more debt you have, the less you can borrow. So overall, if I was to put a figure onto this, I would say it's probably reduced lending by around 5% of your maximum borrowing capacity. And in terms of interest rates, expats, you can still get interest only interest rates, but at a premium, which is around 0.2 to 0.3% on top of what you would pay if you did principal and interest repayments. Principal and interest repayments are still the standard, and most of our clients are on principal and interest, and that's because it's just a low interest rate. So at the moment, you can get fixed rates from 2.49, variable rates from 2.39. And on the right-hand side, I've got a chart here showing the average interest rates an Australian in Australia is paying right now on their mortgage. So left-hand side, you've got the owner-occupier, right-hand side, you've got investor. Purple line is principal and interest repayments, and the yellow line is the interest only. Something you notice is on the owner-occupier side here, you see a big gap between principal and interest interest only. And that's because the regulators really want people who have their own homes to pay down their loan. So they incentivize that with lower rates, and people who are not paying down their loans as an owner-occupier, they're actually paying even higher interest rates than an investor on their rates. So investors at the moment, around 3%. So if you have a home loan and your interest rate is above 3% at the moment, definitely come have a chat with us, and we'll be able to refinance you to a much lower interest rate. So I want to talk about what the banks are looking at specifically when they're thinking about lending you money. It's many variables, especially for people living overseas, but ultimately it comes down to two main factors. All right, the first one is your deposit, how much money, how much cash you have. The second one is your income or your disposable net income, which is just your income after expenses and tax. So first, your deposit. This is quite simple. It would just be, your bank savings or any other liquid assets like shares or equity from existing property. And I'll touch on this in the next slide. So quick example here, if you're buying a property for $1 million and you're borrowing 80%, 800,000, you add on stamp duty, which is roughly 5% of the purchase price, you need to come up with $250,000. So the bank just wants to see that you have $250,000, in your bank account or shares or equity. That's simple enough. So what I mean by cash out equity from your existing property, I'll give you an example here. If you bought a property, say 5-6 years ago, in 2016 for 600,000 and you got a mortgage of 80% against it. And let's say it's increased in value by 6% per annum, and it's now worth $800,000. And in that time, you pay down your mortgage from 480 to 400,000. Your loan to value ratio is now 50%, from 80 to 50%. And now you can actually top that back up to 80%. So you could top that back up to 80% and cash out equity of $240,000, which you can use to assist you in the purchase of that property. So if I was to use that example from before, instead of coming out with $250,000 of your own cash, 240,000 of that could be equity from your existing property, which means you only need to really come out with 10,000 of your own cash, which is great. Number one, you can unlock the capital gains from that property. So if your property went up in value greatly, like it has been in the last several years, in the eastern states especially, you don't have to sell that property to realize or to use those funds, right? You could actually just release cash out equity. It also helps you minimize your cash contribution. So like in that example, you only need to come up with $10,000 of your own cash. So the cash sitting in your bank account now can be used for other investment purposes, investing in shares or equity or other personal expenses. And it gives you an opportunity now to also refinance and sort of consolidate all of your mortgages, maybe into a lower rate product. And we have some banks at the moment that are doing cashback incentives. So they would probably take, the cashback is up to $3,000, whereby a bank would pay you $3,000 to refinance across to them, and that's nice. It just covers all of the fees associated with this exercise. Obviously, it doesn't come without cons. You are borrowing more, so there's going to be more interest, larger repayments, and you can be careful not to over leverage. Because the worst thing to do would be obviously to borrow more to invest in a property that goes down in value. So, you got to pray to that investment god, or just use a buyer's agent and increase your probability of success by, 20-50%. So second main factor, actually, this factor is probably the more important one, which is income, and it catches out a lot of expats. So, and I'll go through an example here, because there are over 40 different lenders in Australia, and the majority of them do not lend to people living overseas. And the ones that do can be quite harsh, and there are some that are quite friendly. So, on the right side, we'll talk about the expert-friendly banks. On the left side, the regular banks that would lend to expats. So let's say you're Singaporean and you're earning 20,000 Singaporean dollars per month. Straight off the bat, the bank will discount your income by 20%. And the reason why they do this is because of foreign currency fluctuations. So especially during COVID, you would have seen that the Australian dollar was quite volatile, right? And it went tanked down and then it bounced back up. So it's fair enough that they discount by 20% there. And then they apply Australian income tax rates. This one makes less sense because in Singapore, Hong Kong, Middle East, the income tax rate is quite low. I'll use 30% here as the effective tax rate. And so we're left with 11,200 Singaporean dollars per month that we can use. And in Singapore, Hong Kong, the rent relatively high compared to Australia. So if you have a family, $6,000 per month is not unheard of. And you're left with 5,000 Singaporean. and then just general living expenses, especially if you have kids and they go to private school, that can actually increase that quite a fair bit more. So then you're left with 1,600 Singaporean dollars, which equates to around $250,000 in borrowing power. So if you're someone you're thinking, I earn 240,000 Singaporean dollars, I don't have any liabilities, I'm just renting, and I can only borrow 250,000. It blows a lot of people's minds. So now on the right-hand side, expat-friendly banks take the same thing. So an expat-friendly bank won't even discount your income, right? So you can use all $20,000 straight up, and they will allow us to use the local country's income tax rates. So in actual fact, for someone earning 240,000, I think the effective tax rate is around 13% or something, but I'm just going to use 15% here. So you're left with 17,000, rent expense minus that, minus living expense, you're left with 7,400, which equates to $1 million in borrowing. Okay, so that's a 4x increase by just choosing a bank that's friendly or one that has more lenient credit policies for expats. And that's really where we come in. As expert mortgage advisors, we can tell you exactly which bank would do what, tell you exactly how much you can borrow, the lenders, your lender options, the rates, fees, and so forth. So if you're buying a property, highly suggest you get a pre-approval. Pre-approval is just pretty much a letter from a bank saying, hey, you can borrow X amount. Okay, it mitigates against any potential loss of deposit. So if you were to sign a contract to sell and you did not have pre-approval, and later you found out that you couldn't get the finance, or you went with a bank that rejected your finance, you can potentially lose your deposit because you did not get finance in time. Gives you negotiating power relative to other people who don't have finance approval, because then the seller just knows that you're ready to go. If they were to sell you the property, it would go through without a hitch. And a pre-approval will last for up to 6 months, so you can just focus on the buying of the property aspect. Excuse me. And it costs nothing. So to get a pre-approval, doesn't cost anything. All the bank fees are only payable upon the date of settlement. So I want to talk about that ideal timeline here. This is like the perfect timeline, just from our perspective as a mortgage broker. So the first step, you do our online form, and it takes 5 to 10 minutes. Then we'll be able to advise you on your lender's options, rates, and fees. You select the bank that you want to proceed with, upload your documents onto our online portal, and then we submit your application. In a few weeks, you'll get your pre-approval. It'll last up to 6 months. And then that's when you would engage a buyer's agent, or if you have someone on the ground, it can help you secure a property. You found a property, you sign the contract to sell, and you give that to us so the bank can order a valuation on the property and issue you the loan documents to sign. Once it's signed and sent back to the bank, we wait for settlement. And once it's settled, we suggest you speak to a tax accountant to arrange your tax affairs at that point in time. This would be the ideal scenario. I think the whole thing would, possibly take between close to 2 months. Well, it depends how long it takes you to find a property, essentially. So this is my last slide. I'll just cover the 3 tips here in summary. So first tip, no bias. Highly suggest you use an expat mortgage broker if you're based overseas, as opposed to a broker residing in Australia or at the bank directly. I think it's just the knowledge that we have in terms of the credit policies to guide you to the right bank from the start. We will save you a lot of time, stress, and money. And we don't charge a fee either. So tip number 2, avoid settlement headaches, maximize the negotiating power with a pre-approval. So if you're buying a property, highly suggest you get a pre-approval. This would apply to 90% of you. Sure, like maybe 10% of you earn very high income with no debt, no liabilities. You could probably afford to buy the property first, or sign the contract, and then get finance afterwards. But for the majority, I highly suggest you get a pre-approval. And lastly, review your existing mortgage portfolio, for cost savings. So optimize it for cost savings, ensure that you're on the lowest interest rates, and see whether or not you can release any cash out, so you can use that funds for other investment purposes. Thanks. I'm going to pass it over to you now, Rich.
Fantastic. Thank you so much, Ben. That was great. I'll just share my screen. So just give me 1 second. It is screen number 2. Cool. All right, everybody see that? So thanks everybody for joining us. We will do all the Q&As at the very end, so please hang around till the end. I know there's some questions coming through, please keep them coming. So my name is Rich Harvey, I'm the CEO Director of Propertybuyer. So I've been running the company for 20 years. Thanks for the introduction, Ben. I won't go through all my background, but you can see it all online there. So today I want to do 5 quick things. Firstly, I want to talk about the key factors that are going to drive this market in 2022 and beyond. Have a look at some forecasts, how you can buy a property safely and securely from overseas, talk about some equity building strategies, and then also talk about where you can find positive cash flow properties as well. So I hope that sounds good. Yeah, we can't get feedback, but I'm sure a lot of you give me the thumbs up. Awesome. So what's going to drive the market in 2022? Well, there's a couple of things here. Number one, we are seeing a good, strong recovery. There's still obviously major disruptions to our supply chains and certain sectors of the economy that are really hurting, particularly hospitality and travel and tourism. I really feel sorry for our colleagues that are struggling to get up and running and have been smashed by so many COVID lockdowns. But a lot of the other parts of the economy are really firing. And so we've got a shortage of labour at the moment. So we're going to start to see a bit of wages growth later in the year. Unemployment's been as low as I've ever seen it. We've got a lot of people who have saved money in their balance sheets during COVID. We haven't been spending as much. We're going to see the continual trend, what we call the exodus to affordable lifestyle. So people returning to lifestyle regions because they don't need to commute to the city anymore. And obviously with expats, we are seeing a large number of expats coming back to Australia. They've either had enough or just missed their families or want a change of life, want to come back home. So we are seeing that, and that's driving demand as well. Property investors are definitely in the fray. Again, with interest rates staying low for still some time, people are still going to upgrade their homes and keep wanting better properties. So they're the basic factors for this year, but there are some what I call X factors to watch out for that'll have a few ups and downs of the market. Firstly, the federal election. We typically find people just put their plans on hold during an election, but I've actually found it's a great time to be buying. When other people are sitting on the sidelines, that's a good time to get out there. Obviously, when the borders, when I say fully reopen, they are open, but to actually see a flow of migrants coming back into Australia, like trying to get the numbers back up to 150,000 a year, that won't happen, I don't think, immediately, but it will happen at some point. We're going to see continued spending on infrastructure. We've talked about those lifestyle destinations, and there is a federal parliamentary inquiry into housing affordability. I don't know why the government's wasting time on this. They're going to come to the conclusion that there's too many prohibitive taxes and they should have a more responsive supply chain, give councils quicker powers to approve developments and increase land supply. So there's the answer that they should have for the housing affordability right there. But instead, they'll spend millions of dollars and take months to find that out. I am a bit cynical, but all right, let's have a quick look at the market. Where are we up to in the housing market at the moment? So quick overview. Last year, we saw staggering increases. This is Australia-wide. We saw a 22% increase Australia-wide. The last 3 months of last year, the peak price growth started to decline. And if we look at the individual values of each capital city, Sydney basically these need to be updated. These are last months. They're really up to about 1.5 in Sydney, just over 1 million for Melbourne, 684 for Brisbane, etc. So we've seen significant rises in house and unit prices last year. If we look at the actual percentages for each capital city, we saw quarterly price changes. This is the last 3 months that we've seen. We've seen Brisbane and Adelaide lead the fray at 8.5 and 7.2% respectively. Now, Sydney and Melbourne, you can see that they've definitely declined. These two darker blue lines here. Sydney's down to 2.7 for the last quarter and 1.5 for Melbourne. I think you're going to continue to see strong growth in Brisbane. That's one of the markets that I'm tipping for next year this year to be the strongest. And if we look at the overall 12-monthly picture, you can see that we are past peak price growth. Prices have peaked. This is for Perth, Hobart and Darwin and the ACT. Again, they're off their peak as well. 4% there for Hobart, 4% there for the ACT. Those markets have also performed well. And just going to the next slide, which is annual price changes. So over the last 12 months, we've seen that Hobart's been one of the standouts, 28%. Actually, regional New South Wales is 29.8%. Canberra 24, almost 25%. Adelaide 23, Brisbane 27, and Sydney 25%. I don't know a time in my career where I've seen property prices rise so quickly and so rapidly. I mean, I live on the Northern Beaches and prices actually rose 37% in the Northern Beaches last 12 months. So quite remarkable rises. So if we also look at now sales volumes, obviously in 2020, sales volumes took a dive with COVID and lockdowns, but then we saw a rapid recovery with sales volumes really starting to spike up again over the last 12 months. And I think you'll see the first 6 months of this year, sales volumes start to really shoot up again as people and vendors try to take advantage of what was a fairly strong market. Looking also at listing volumes. Now, during lockdown, I'd always have a slide on the volume of listings. And during lockdown, we always saw that listing volumes are down about 30%, their 5-year averages. We're down to about, you can see this number there, 24.7 below the 5-year average. So we are putting a dent in the long-term trend that's been down. But listing volumes, as I said, have definitely started to spike back upwards again. So this dark blue line shows where we're at in 2021. But I think 2022 will start to get back to a bit more normality in terms of total volumes, which will then help buyers to get into the market. Days on market is a reflection on sort of the speed at which a sale occurs. And you can see generally regional areas, it takes a lot longer, but in all the capital cities, I mean, look at Hobart there. It was 9 days. It was ridiculous in December. It was crazy. Sydney was 23 days. Melbourne 25 days. So pretty quick averages. Normally Sydney, Melbourne are around about 42, 46 days. The other capital cities are around 50 to 60 days. So we've seen a dramatic speed at which properties were sold last year. Now, turning to the rental market, I believe we're going to have a rental crisis in the next 2 years. We're not building enough properties to cater for rental demand, and this is starting to show up in the figures. You can see this big spike here in the value of rents that's really gone up in the last 6 months, last 12 months, and I think that'll continue to grow as we have people that are wanting to get into the rental market, but again, supply is limited, and that will continue to bode, unfortunately, not so well for them. If we look at my predictions, so what I'm predicting for this is a 12-month for the housing market. It's for individual houses, not apartments. These are my figures. So I'm predicting a positive increase for all capital cities next year. But the standout for me is Brisbane, followed by Melbourne, Canberra, Adelaide, and also Sydney, around the 6 to 7% mark. So I think we're going to have a much more moderated rate of growth. Obviously, if we do get interest rate rises, that will put a dent in that, but I don't believe we're going to get rate rises until either very late this year or very early next year in the market. So I'd like to talk about now just a couple of steps. How can you buy safely and how can you buy well if you are sitting in Hong Kong or Singapore or any other part of the world and trying to buy a piece of Australia? What can you do? Well, there's basically 7 steps that any buyer needs to go through. You've got to have a strategy. You've got to research the market that you're buying in. You need to shortlist those properties. You need to physically inspect them, evaluate them, organise a pest and building inspection, and then negotiate and secure it and organise contract exchange and settlement. So it's quite difficult to do that remotely. One of the other things to think about is obviously, as Ben has said, you've got to have your finance approved. Don't ever think about putting an offer on a property until you've got that magic piece of paper from the broker saying you are pre-approved up to a certain limit. You also need to have options B, C, D, and E. I think a lot of people got FOMO during COVID and just putting crazy offers. So you've got to have multiple buying opportunities. You may not buy the first property you see. And as I said, you must do a physical inspection. If you can't do it yourself, use someone who's independent. We often get called up by a lot of relatives who say, look, you know, my friend in Singapore has asked me to buy this house, but it's too much pressure. And it is. It's a very, very significant amount of pressure that you're putting on someone else if they're not trained to actually go and do those inspections and work out what to pay. Try and access some off-market opportunities by getting on agents' databases. And it's really important not to overpay. And you're going to have agents who will be very clever in their dialogue with you and their techniques, but you do need to be careful of that. And another point here, the last one, is this: watch buyer fatigue. A lot of buyers get very, disillusioned and frustrated with the market, and find that they're just spinning their wheels. So just be aware of your own emotions when you're going through the whole buying process as well. So key benefits, just obviously in using someone like ourselves as a buyer's agent, we will help you work out a strategy. We have a lot of off-market properties that we get access to. We certainly act as a professional negotiator, and I've trained my team very extensively on negotiation techniques. We're going to have local experts that will be looking after you. We evaluate the numbers really well, and we just give you that overall level of confidence that you wouldn't otherwise have on trying to buy it on your own. What are the fees? We work on a fixed fee structure. It's the equivalent of between about 1.75 to 2%, but just send me an email and I'll send you our fee proposal after this webinar today. So you pay an engagement fee of between $3,000 to $5,000 to kickstart it, and then you'll have one of my team that'll work with you one-on-one to go through the whole process of finding the ideal property that'll suit your budget. So I'd like to just move quickly to equity building and cash flow strategies, and then give you a couple of examples to finish up. So a couple of things you can think about doing to build equity. One is the classic buy and hold. So buy and hold a property, quality property in a growth area. You might not even do anything to it. It's just simply knowing where to buy and what to buy in that area and holding it. And that just builds equity over time. A lot of people get really impatient, unfortunately, with property investing. And they think if they put $1 in, they're going to get $2 tomorrow. Well, it does take time. It's pretty boring property investment after a while. But I tell you what, once you've got into the market, it's a great thing to hang on to. Another strategy is to add a granny flat. That not only adds equity, but it also gives you extra cash flow, which the banks certainly love. If you can get an extra income from a studio flat or a two-bedroom flat down the back. Add a bedroom. I've done that a couple of times and dramatically increased the rent on the houses I've owned. If you want to get more sophisticated, you can do a subdivision, or you can even consider doing a duplex or a dual living property. And that's another significant way. It's a few more risks involved. You need to get a construction loan and organise council approvals, but that's another way that you can add value and build equity. All right, so I want to talk to you about some case studies, and in this I'll share with you some areas where we're buying some positive cash flow properties at the moment. So a couple of examples to finish off with. This is a townhouse in Mona Vale that I bought just last week for a client. They had a budget up to 2.1. This client, they loved kayaking and all the lifestyle. So this was it was only on the market for a couple of weeks. We just bought that last week. We got that for $2 million. It's about 175 square meters internal, but fantastic location. Opposite the golf course, 200 meters to the beach, 100 meters to the shops. So a cracking location. This is one in Melbourne. This is for an investor. They had a budget up to 1.4. So this is near the Frankston area. So we got this for 135, rents for $850 a week, but on a really good sized block of land. And you can just see by the quality of the property, it's a really nice high quality property with a great backyard. So that'll rent out to a family in no time. That'll be snapped up super quick. Another one we also bought in a similar area. We got this one for a slightly better yield. Got this one for 1.13. And that was a 3-bed, 1-bath, 3-car home. You could even potentially convert some of the garage actually to an extra couple of bedrooms. So there's opportunities to add value and even just put a carport or build a garage up the front there in Melbourne. Another one we did in Melbourne in St Kilda. This was a double-story apartment, a 3-bedroom apartment, really nice layout upstairs, which is great for working from home. So you could have your office upstairs and then you're living in other 2 bedrooms downstairs. But we got that again really quickly, just by knowing the local agent and being able to move really quickly. We picked that up for $660 in St Kilda. Brisbane, as I mentioned, a really good area. We're getting great yields for our investors in this market. Usually some of the houses under 600K, we're getting yields around 4.5% to 5%. And again, you've got to move super quick in the Brisbane market. There's such high demand there. If any of you have tried to buy a property, you'll find how much demand there is at the moment trying to get something there. So pretty strong. This was one we just bought toward the end of last year, and we simply got this because of our strong relationship with a local agent. Glenn Sainsbury, who's our team leader up there, he managed to get this significantly under market value just by moving really well with the negotiation and moving really promptly to get this under wraps. So trying to find out sometimes what the motivation of the buyer might be. They might have bought somewhere else and they didn't quite get a strong enough offer on the last contract. So he was able to snap this up for 777 and get a 5.3% yield on that one. I've done the wrong photo on that one, but this was another off-market deal that we got. I've just misplaced the photo on that one. I'll go to the next one. Now, where can you buy positive cash flow? Well, if you can get over 5%, it's generally going to be positive cash flow. We are buying in areas like Toowoomba, which is 90 minutes west of Brisbane. And that market, we can get houses for under 400K. And they're generally renting for about 5 to 5.5%. So very strong investor demand out there, but there's a lot of good drivers for investors. You've got a good mix of agriculture and other types of industries that are supporting, and also the main train line and an international logistics hub that goes through Toowoomba, as well as a private airport that does it. It's very, very busy. Another one we got in Toowoomba, this one was for 410, rents for 420 a week, a 3-bedroom house. Again, another off-market deal through our connections in that market there. Oops, going the wrong way. Surrey Hills, this was one we bought again toward the end of last year. This was an expat client that wanted to buy, in really close to Sydney CBD. They worked in the city, just want to be able to walk to work, and we actually bought this for a very similar price to what the owner had paid for it a couple of years ago. So there was just a lull in the market for a couple of weeks, and we were able to snaffle that for a fantastic price. And that work was done in 2 weeks, so very quick turnaround time. Another one here, this was actually a client of Odin's, one that Ben and the team referred to us. We got this property in the inner west of Sydney. Again, just by moving at the right price, we got it for our client from 30 days. And Munro Donan, who's our inner west and eastern suburb specialist, looked after this client, did a great job. We're also buying in Newcastle, just 2 hours north of Sydney. Really strong market, a lot of new gentrification going through there. You've got a light rail that goes into the centre of the city. You've got new university buildings. You've got new law courts that have been produced. A lot of Sydneyites have moved up to Newcastle simply because they love the lifestyle and they can get better jobs and have much cheaper housing for half the price. So we're seeing that market continuing to thrive and go forward. And lastly, this was one we bought very end of last year in the Shire. Stuart did an incredible job for this client, got it pre-auction and just managed to secure a long settlement. They're actually just settling, I think, next week. So that was a great buy. So whatever price range you've got, we can certainly help right across the board. Oh, and also Western Sydney. Another strategy we've done is buying older houses and adding granny flats and doing renovations. Very hard to get yields over 4% in Sydney, but with the granny flats, we've been able to do that in particular areas like St Mary's and Penrith, where the new train line is going through. So I think I've pretty much, John, stuck to my time. Hopefully I'll give you enough time to get through all the tough tax questions, mate. But if you do have any questions for me, please, I'll be moderating the Q&A session. There's all my details there. We'll be sending out the slides. So I know I went through it super quick with all of those charts, but feel free to have a look at the display as it comes through. So John, I'll unshare my screen. How do I get back to that one there? Stop share. There we go. So John, over to you.
All right, thanks, Rich, and good afternoon, everybody. John Murphy is my name. I'm the principal consultant at Connole Carlisle Chartered Accountants. Been in practice as a chartered accountant for 30 years, and prior to becoming the principal consultant on the 1st of July last year, I was a managing partner at Connole Carlisle for the previous 16 years. Pre-COVID, I spent half my life in Australia. So I divided my time then between my Australian practice and my Singapore practice. Pretty much now, since I've retired from the equity, I devote all of my time to my expat clients, which I take, I get a lot. I enjoy doing expat tax. So if one can enjoy doing expat tax, well, I do. So let's run through what I'm going to be talking about with you today. 4 things. How does the Australian tax treatment differ between residents for tax purposes and non-residents? Common mistakes that I see in expat tax returns. So I review a lot of expat tax returns and see quite a few mistakes in them, largely with accountants that aren't particularly familiar with non-residency issues. I'm going to run through some strategies for the year ahead and then talk about holding property in trusts. Is it worth doing? And then, as Rich mentioned, he's going to moderate the Q&A session, and we've already got a reasonable list of questions that keep coming through. All right, how does the Australian tax treatment differ between residents and non-residents? Lots of many differences, but the main ones are. So these are the rates of tax. And I guess if you look at the table on the right-hand screen, or the right hand of the screen, under non-resident tax rates, you can see that non-residents pay tax from the first dollar of Australian taxable income that they earn, whereas those tax purposes, you get a reasonable tax-free threshold, which I think when I first started was $5,400. It's now $18,200. So we're paying a little bit less tax. As you can see, as your income increases, both as a resident and a non-resident, your rates go up, but rather non-residents only have three rate thresholds. The overwhelming majority of non-resident returns that I look after pay no more than the 32.5 cents, usually only getting into the other rates if they end up with some significant capital gains tax issues. Okay, so when you become a non-resident, your capital gains tax general discount ceases. Now, this is a topic that I could spend the whole of my lot of time talking about, but in simple terms, as a resident, if you acquire, let's say, a share in National Australia Bank today, and then sell it in 12 months' time, or more than 12 months' time, you'll get a 50% discount on the gain. So if you made $100, which would be great, but you wouldn't. If you made $100 in the gain, you'd only pay tax on $50. Whereas when you cease being a resident, and this has been the case since 2012, that the accrual of that general discount ceases. Debt left over from Australian University. And I'm still finding lots of clients that have, they're out of the Australian tax system that the ATO hasn't caught up with yet. But if you've got a HECS debt, for the last few years, you've had to make annual repayments based on your worldwide income. So you don't have to pay income tax on your worldwide income in Australia, but whatever contribution you need to make to your HECS and help debts are based on your worldwide income. And as I'm sure has been a barbecue stopper, or was a barbecue stopper in expat circles a couple of years ago, the capital gains tax main residence exemption is no longer available to non-residents of Australia for tax purposes. Now, simple mantra, residents of Australia pay tax, or for tax purposes, are liable to tax in Australia on their worldwide income. Yet, non-residents of Australia for tax purposes are liable to tax in Australia on their Australian sourced income. So what are some examples of Australian sourced income? Main one, rental income from a property in Australia. Interest from an Australian bank, but it's actually withholding tax that you're paying rather than income tax. And the rate that you pay is based on where you reside and the double tax agreement that we have with that country. Unfranked dividends from an Australian company, and again, the rate of withholding tax is based on where you reside. And then capital gains from the sale of Australian property assets and on any assets that were not deemed disposed of when you left Australia. That of itself is a fairly detailed subject, but suffice it to say, a quick example there, I had a client a couple of years ago who worked for Apple. He left Australia. His Apple shares were not particularly valuable the date that he left Australia. he saw that they were going to increase in value. So in the year that he left Australia, we declared the gain based on the then price on the day that he left Australia versus his cost base. He then paid that capital gains tax, and what that does, it takes the future sale of those assets whilst he was a non-resident out of Australia's tax take. He saved a couple of $100,000 from memory, so fairly significant. Now, common mistakes in expat tax returns. What are they, and how is it best to avoid them? So these mistakes are ones that I've seen. As I said, whenever I take on a new client, one of the services I offer is a review of their most previous 2 returns for free. So these are in any particular order, but these are ones that keep coming up with a fair bit of regularity. Now, I don't know how that happens, but not claiming all available interest deductions. So you might review a client's return and see that the interest that they pay or claimed in year 1 might have been $26,000, and the next year it might be $7,000. You just realise that they haven't shared all the information with their accountant as regards the total of their interest, but the accountant hasn't queried it. The next one, which is almost every return that I review, you talk to the client about, well, how come there's no building allowance deductions or depreciation? Given a blank look, and what, your accountant didn't ask you to get a taxation depreciation report? No, I wouldn't have a clue what one of those is. So you run through with the client, when did you buy the property? Oh, I bought it in 2014. How old is it? Oh, it's a 9-year-old house. Well, you're missing out on many, many thousands of deductions or dollars in deductions each year. The next one's land tax, and it's not really a return mistake. Well, to an extent it is, but it's more an advice mistake. So with land tax, every state and territory in Australia has land tax. Tax is not levied against the property, and unless and if you contact your state office of state revenue when you move overseas and start renting your property, they're not going to become aware that you are no longer eligible for the land tax exemption. So usually they will catch up with you. So if I've got a client that I can see that they've got, say, a substantive house in Sydney that would ordinarily be subject to land tax, and we inquire, work out that the rateable value is above the land tax threshold, well, you can end up with some pretty nasty surprises. One that came across my desk was a couple in Melbourne who had a substantial house down there at Williamstown that they ended up having to pay $170,000 to the Victorian OSR when the Victorian OSR caught up with them, including $25,000 worth of non-deductible penalties. So with that, I suggest that if anybody's got substantial properties, and I can't give you a value, and it's all based on the rateable value, so look at your rates notice, check against the Office of State Revenue in each of your states to see whether or not it's over the threshold or whether the combined value of all your properties is over the threshold, because if it is, you aren't paying land tax and you'll most likely get caught up with. Okay, treating the taxpayer as a resident of Australia for tax purposes when they are clearly a non-resident. Now, these are actual examples that I've done. So you're an Australian citizen, so you can never be a non-resident. Well, that's just patently wrong. You're a New Zealand citizen and lived in Australia for 20 years, but you can never be an Australian tax resident. That's patently wrong. You own a house in Australia, so you can never be a non-resident. Wrong again. Now, further mistakes, initial repairs. Again, this is a topic that could take up even longer than I've been allotted. What do I mean by an initial repair? So an initial repair is a repair undertaken to a property where the problem, if you will, existed at the time that you committed the property to the rental arrangement. The worst one of these I've seen was last year. I had a client where the previous accountant allowed him a deduction for a full internal and external repaint and a roof replacement, even before the rental arrangement commenced. Now, even if he did it and paid for it after the rental arrangement commenced, it's obvious he carried the property into the rental arrangement with a dodgy roof and worn walls. That was never going to be deductible. Interest and dividends being included as taxable income. Well, you don't put them in the return in the normal section of the return. They go in as withholding tax, and as an example, in Singapore, the interest rate paid on, the rate of tax paid on interest is 10%, and the rate of tax paid on unfranked dividends is 15%. Now, fully franked dividends, such as you usually receive as an example from Australian banks, they're not taxable to non-residents. We don't even put them in the return, so they need not go in the returns. I've seen lots of people that are non-residents but then have their returns lodged as residents and end up paying Medicare levy. Non-residents don't pay Medicare levy, full stop. And a reminder that I always put into my slides if I'm bringing up the topic, a lot of expats don't know this, Australians can continue to access their Medicare benefits for up to 5 years post non-residency. So if you become unwell whilst you're overseas and prefer to get treated back at home, and it's within that 5-year time period, well, you can continue to access your Medicare benefits. This is a bit of a difficult one. Very, very hard to get retrospective valuations. So let's just say you're living in Sydney at the moment, you're moving over to Hong Kong, and your property is your main residence. You've purchased it and moved straight in, or bought the block of land and built the house and moved straight in. Under section 118.192, at the time that you first rent your property, you can then deem its value at the time that you first rent it as the value for capital gains tax purposes under certain circumstances when you sell it. So I urge anybody that is considering doing that or has recently done it, go and get your valuation based on the value of the property on the date that you first rented it. But the two trigger points are the main trigger point is it's subject to the main residence exemption and you have just rented it. So that would be your valuation. All right. So tax and other strategies for the year ahead. I guess these are just some thoughts that I've had. Tax planning for expats is notoriously difficult because there's not a lot you can do. But I guess the first one, which again is a bit of a barbecue stopper in expat land, keep a close eye on the proposed residency changes. Legislative announced they will have significant implications for expats, mainly the 45-day rule. Rich, will we deal with that in Q&A, or would you like me to expand on that now?
I think you do it now, John. Just address it now briefly. Yeah, thanks.
All right. So I did a number of seminars last year for some advisors up in Singapore, some financial planners and their various clients on the proposed residency changes. There's a few things to make clear. What did the rounds in Singapore, certainly amongst my client base, when the announcement was made in May last year, was that people should start, there was an Australian Financial Review article that suggested that people should start counting their 45 days. That's just absolute nonsense. All we've had is the government has announced they're going to make changes to the residency rules. They're based on, look, I'm just reading straight out of the budget paper extract from my old slide. They're based on recommendations made by the Board of Taxation in its 2019 report. Now, based on recommendations doesn't mean that they're going to adopt them lock, stock and barrel. So that's point one. Point two, they take effect on the 1st of July in the financial year after they're given royal assent. So legislation has to go through 2 houses of Parliament, be signed off by the Governor-General. Let's say that happens on the 18th of September 2022. Well, these changes will commence on the 1st of July 2023. So we don't have to be counting days at the moment. We don't have any draft legislation. So still, we're now, what, 8 months after the announcement was made, we've got nothing to base any decisions on. So for the moment, the 45-day rule, which, and again, without spending a long time on the arrangements, quite simply, if you're an Australian citizen and you have got interests in Australia, say a property, and you spend 45 days in Australia, you will be caught as an Australian tax resident based on the arrangements as they've been detailed in the Border Taxation's report. Whether that happens is anybody's guess. As I mentioned at the very, very start, talking to Rich, I've tried through my federal member's office to get a bit of a heads up, but there doesn't seem to be any appetite for this at all amongst government at the moment. I guess they're dealing with a pandemic and we're only a few short months away from an election. So anybody's guess when or if that's going to happen. Undertake a review of your loan arrangements, and I saw the interest rates that Ben put up earlier, and the last client that I had who I suggested have a bit of a look at their interest rate was paying 4.6 or 4.7%. So consider prepaying some interest expenses. Now look, if you thought that by doing so you could get a lower rate of interest or lock in a lower rate of interest, if you needed to do so for tax purposes to push some taxable income into next year, that's something that you could think about doing. Super contributions, they are a viable strategy for expats, depending on what their plans are. If they are planning to come back to Australia, does it give them a tax benefit? Certainly anybody in an SMSF, it's not going to work for you, and your super fund within which you've got money has to accept contributions from non-residents. Not all of them do. As I mentioned before, have you got a tax depreciation report for your rental property? If not, consider obtaining one. And lastly, if you are repatriating or expatriating, ensure that you obtain tax and other advice well ahead of the event occurring. Last main topic is holding property in trusts. Is it worth it? Family trusts or discretionary trusts that I look after, the overwhelming majority of them are for people operating small business. Now, I do have a small number of clients that hold property in family trusts, and I don't believe I've got one that's negatively geared. Now, trusts are a viable vehicle for holding positively geared property. Now, negative gearing losses in properties and every other type of loss that you incur in a trust, they're carried forward until they're used up by either positive rental, other income, or capital gains. Now, in comparison, negative gearing losses from properties held in individual names are immediately available to offset other taxable income. So you get immediate bang for buck, whereas if you hold it in a trust, those losses just keep snowballing until such time as you could use them. Now, buying a property in a trust could incur stamp duty and land tax imposts, depending on whether the foreign trust definition is triggered, and that's on a state-by-state basis. Most of the clients that I have that hold properties in trusts are doing so for asset protection purposes. Now, it may assist with asset protection. There's no perfect solution for asset protection. Putting it in a trust does provide a bit of a buffer. Non-residency of either a trustee or trustees or the beneficiaries does complicate an already complicated tax situation. And lastly, Labor have long wanted, pretty much through and prior to my time in practice, wanted to reform trust taxation. They had a crack at doing it at the last election and they obviously lost. And I think their tax platform was one of the very reasons why they lost. And if we see a change in Australian government where Labor's got the upper and lower houses, we could very well see significant changes to trust taxation measures. We're a full service practice. We do all manner of Australian tax and accounting. And as I mentioned earlier, I now pretty much specialise in doing expat tax. from simple individual income tax returns to expatriation advice, repatriation advice, structuring, capital gains tax advice, which is very, very complex for non-residents. And there's a big list of things that we do, but pretty much from my side these days, it's just the expat world. And there we are. So thank you very much for listening to me.
Fantastic, John. Thank you so much.
Over to you, Rich.
Awesome. Well, look, we're going to throw straight into the Q&A session, so we'll jump straight into it. People are asking, can we get a recording? Yes, again, we will send a recording and the slides to everyone. Medi's asked, Rich, we feel the Central Coast market is going down. I think higher interest rates and current stock values will drop, and we're pessimistic about the future. Well, that's just an opinion. I totally believe the Central Coast, to be honest with you, will continue to rise as a market, because there's a lot of first home buyers moving into the Central Coast, and it's only 1 hour from Sydney, and there's some beautiful waterways. You do need to be careful which markets you buy in, though, in the Central Coast, but overall I think it's a market that has a very strong future. Sandeep is asking, do property buyers help buying newly built townhouses? Reason being, I'd like to utilise it for tax depreciation benefits. Yes, we can help you buy a new property, Sandeep. We generally buy established because we find that they're better value. You tend to pay retail price when you're buying from a developer, rather than buying a fair price when you're buying an established property. But the other thing I'd say is that don't buy property just because there's tax benefits. It's the icing on the cake. John's nodding his head there. Thanks, John. Appreciate you agree with that one. And what's your comment about buying new versus old, out of interest, John?
Look, I agree with you versus the retail versus wholesale. And at the end of the day, the building allowance, there's two elements of depreciation. The building allowance amount being the 2.5% on the fabric of the building. You lose that against your cost base anyway. So for me, it's all about the quality of the property, the yield, resaleability, all of those things. And you're right, tax benefits are really a second thought. And since 2017, the second element of depreciation being on the carpets, curtains, blinds, etc., you can't claim depreciation on that anymore for elements that you bring in to a rental property arrangement. You can claim it for elements that you acquire during the rental property arrangement, but not elements you bring into the rental property arrangement. So
perfect. Excellent, very good. Question from Joe for Ben. He's asking about, I think the question was around your topic on pulling equity out of a loan. Will this increase your monthly mortgage repayments before you use the funds? So he's saying, if you pull the funds out and they just sit there, are you going to pay interest, or do you only pay interest once you start using them?
Yeah, that depends on the repayment type. So if your loan is interest only and you didn't use any of the equity funds, then your balance of that loan is actually $0, right? Because it's just like a big credit card. Just think about it. You're not using it, and so therefore there's no interest on that loan. Therefore, you're not paying any repayments. But if you selected principal and interest repayments, you will be required to make monthly repayments. But that repayment would just be principal component only, no interest. So essentially, you're just paying back the money that the bank gave you.
Okay.
There's no cost.
Awesome. There's a similar question from Jess. If you release the equity, does this mean when you try to borrow, the bank will look at your existing borrowing, which would now look higher after releasing the equity?
Yep. Yeah, it will. So yeah, it will. The equity forms part of your overall loan, even if you don't use it. Even if you don't use any of the equity, just like what Joe said previously, the banks say that you have the ability to use that loan. And because you have that ability to draw down on that loan, they have to take the full picture. So, yeah.
Yeah, great. Okay. Callum, interest rates for regular banks versus expat friendly banks. I always told expat banks are a lot higher. Well, I think Callum, as Ben's presentation has pointed out, it's very important to use an independent broker that can guess the best rate for you. I've just done a refinance, and it's incredible what brokers can do for you. So I highly recommend you get in touch with Ben. Someone's asking me about guidance for non-major city areas to be looking at for 2022, particularly Victoria. I mean, that's like asking how long's a piece of string. I think, look, we have an office in Victoria, Sydney, Newcastle and Brisbane and Gold Coast. The best thing to do is have a strategy chat with us and we can talk about a specific area to work out whether that's going to work for you. Question for you, John. Do you need a valuer or can an appraisal be used for valuation purposes?
Well, look, a report from a registered valuer is the gold standard. In my experience, when I've had clients go and get agents to do an appraisal for CGT purposes, they're vague and usually present in a range. So usually I ask, well, let's have a look at what the appraisal the agent might do. And if it's got a fair bit of detail and if it compares recent other sales, and if it did a range, if it went 1.5 to 1.55, we'll usually we'd adopt 1.525. But as I said, the gold standard is a valuer. Impossible then for the ATO to question that.
Okay. And can you also help people with tax in Italy?
Sadly, no.
Okay.
Beyond my scope.
No worries. Rich, do you do commercial property? Yes, we do. We have a commercial division and we bought some great commercial properties last year. So please get in touch. Ben's asking, if an investor wants to buy 5 properties within 1 month after viewing the properties, can the loan quantum of $3 to $5 million AUD be arranged? Will it be with one company or multiple lenders? So Ben, that's a question for you. Investor wanting to get multiple properties.
Yeah. No, you can do all 5 properties, borrow all 3-5 million in total with the one bank. That's possible. But or it can be spread out across 3 or 4 different banks. There's a bunch of variables in this. Like if you maxed out the lending with one lender, then sure, we can then get your 3rd and 4th property with the 2nd lender. But we would obviously pre-plan all of this and then submit it all in one go. Right. If you're buying all 5 properties in 1 month.
Okay, perfect. John, question for you. Where do you establish a trust? If you buy a property in Queensland, do you have to set up a Queensland trust or set up in country that you're living in?
You're much better off establishing the trust within Australia. It doesn't need to be established in Queensland. So unlike companies that are incorporated within states, trusts aren't usually an issue. You can have a West Australian trust acquire a property in New South Wales, but common practice is to have the trusts settled by law in the jurisdiction or the state that you're purchasing the property.
Yep. Okay. Anonymous, I'm a foreigner. Can I buy a second-hand resale property in Australia? Foreign buyers can only buy land and then they have to build within it within 2 years, or they can buy brand new property. So there are obviously significant extra taxes and extra stamp duty for foreign buyers. Not completely prohibitive, but you need to be aware of what those numbers are. So again, get in touch with us if we can help you. Rich, do you buy properties in Perth? We refer to another buyer's agent if you're looking to buy specifically in Perth, so just please get in touch. I'll just jump back over to this other side. So there's some in the chat box as well. Since you are very experienced in the Singaporean market, this is for you, John, do you see any benefit of investing in Australia versus Singapore as a GTI/PR holder?
Okay, so that's a difficult one to answer. So it depends where you're living. So if you're a non-resident of Australia for tax purposes and you buy a property in Singapore, it's not going to be taxed in Australia. Yeah. So like any property purchase, it's going to be down to just investment decisions, and commenting on buying property in Singapore as an investment is, sorry, beyond my scope. So
that's fine. Okay. I'll just jump back to Ben again. Ben, how do we open an account with a mortgage broker and what documents do you need? How long will approval take when the loan's going to be $3 to $5 million?
All the accounts are opened up automatically so you don't need to go down to Australia to do any of that stuff. In terms of documents, it ranges, but it's just like general stuff, ID documents, payslip, bank statements, that sort of, well, we'll let you know what you need exactly once we find out about your specific financial position. And in terms of how long it takes to approve a loan, it's not by how big your loan size is. So like the bigger the loan size, or does it take longer to approve? It doesn't. It all gets treated the same. So whether you're borrowing like 100,000 or $10 million, it just all goes through the same process. And it's taking around, I'd say, 3 weeks right now to get a loan approved from submission of application.
Cool. A question from Jürgen. Yield question re commercial versus residential. Any advantages as a landlord for either? My view, Jürgen, is that if you're looking to buy commercial property, I really recommend you have a bit of a buffer or a base of resi properties first. I like to see my clients buy, say, maybe 2 or 3 or even 4 resi properties before they start considering commercial investments, and primarily because of vacancy rates. So if you're buying commercial property, you've got to be aware of, as we've seen with COVID, that if your tenant defaults or can't pay the rent, you've got no income for 6, 9, maybe 12 months. Whereas a residential property, you just adjust the rent 10 or 20 bucks and you'll get another tenant in straight away. So there's an advantage, strong advantage for residential, even though there's slightly lower yields. Well, having said that, you've seen in my presentation, you can get pretty similar yields in resi now than you can get in commercial. So the advantage of commercial is simply that the tenant pays the outgoings, and that's probably one of the biggest ones, and you generally have longer leases. But again, just get some independent advice about which way you want to go on that. John, can there be multiple partners in one self-managed super fund, like son and parents or friends? Well, I know the answer is yes, but I'll let you answer this one.
You're right. The answer is yes. But if we're speaking to expats, or largely to expats or people intending to become expats, if you're already a non-resident, you can't become a member of a self-managed super fund. And if you are a member of a self-managed super fund right now and become a non-resident, your account is affected for us, and you can't make any contributions, and you have to find somebody else to be the trustee of your fund. Now, technically, you can have people outside the immediate family. Out of all the super funds that we look after, they're mainly husband and wife, or a single person, or what have you. But I can tell you through experience, not personally, but with clients, if you've got multiple family levels within super funds or friends, they're almost bound to fail, because people tend to start pulling apart and want to pull in another direction, and suddenly you might find you've got an industrial shed, and there's one example that I had in a super fund that was owned by 4 adults, 2 husband and wife, and they were friends, and they had a big yike, and the property had to be sold and had to be cashed out. So the answer is technically yes, but it's not good to do that.
Okay, great. Another one, John. How about absentee for land tax? Will it influence interest to buy land and house package? I'm not sure what they're asking there.
No, but I guess so. Whether if you're going to be if you're not going to be living in the property, or you're in the property now and you're considering moving overseas, simply do a little bit of research, pull your rates notice out, have a look at what the rateable value is. That is the value that determines whether or not you're within the land tax thresholds for your particular state or not. I think I've only ever seen one strata property that triggered land tax on its own, but usually they're landed houses. So yeah, I read that question before. I wasn't quite sure what that meant, but it's quite simply your property either qualifies for land tax or it doesn't, or the total of your properties qualify for land tax or they don't, all based on the total of their rateable values.
Okay. Another question from Lena. As a first home buyer, when you have the same budget of buying regional New South Wales with government concession, compared with the opportunity to buy a property close to the city in Queensland, Melbourne, obviously no interstate concession, which one would you go for? Look, my view of that is that even all of these, stamp duty concessions, whatever, they're nice, but again, there's no point buying a substandard property, Lena. You've got to buy the best quality location that you can for your budget. It might be nice to get an extra 10 or 15 grand bonus, but if the property is going to grow at like significantly less value per capital growth per annum, you're doing yourself out of a big upside. So my view would be buy the best quality location and then consider any things. It's like that same principle. The tax concessions are the icing on the cake. That's the way to look at it. Another one, anonymous. If I return to Australia after being a non-resident, what period would I need to live here to be treated as a resident and obtain the CGT discount?
All right, so that's the discount recommencing is triggered the across the border and trigger residency. So that doesn't mean that you automatically then get the 50% discount for the whole time. It's prorated and starts again from the day that you trigger residency.
Yeah. Okay. All right. If I'm an expat living overseas, will the banks take into consideration loan and rental income for my properties outside of Australia? If so, will rents be discounted? Over to you, Ben.
Yes. So some banks, it depends on the bank. Probably like half the banks won't look at overseas rental income, that is properties outside of Australia, but then the other ones will. One other thing is that if we don't need to use your rental income from your other properties, then generally we just won't include it in and just keep the loan application simple. But if it's not passing the servicing and we need more income to make the loan pass the stress test, then yeah, we can look at some of the banks that will look at properties from Hong Kong, Singapore, so forth. But it also depends where the property is located. If it's in some of the developing countries, like Africa or some other countries like that, then generally the banks won't look to include rental income from there.
Right. Okay. Look, we're running out of time, so this will just need to be the last question. Another one from Mehdi. I think I responded to this, but Mehdi's basically asking or suggesting he feels the Central Coast is going to go down. Should I buy now or wait? I get asked this question all the time. As I said, I don't feel the Central Coast is going down at all. I think it's going to stabilise like a lot of other areas around Sydney. I think it's got a lot of upside. And for me, I'm actually looking to buy myself. So I'm looking longer term. So I think the answer to your question, Mehdi, is in look at what other experts are doing, but do what's right for you. But for me, I'm looking longer term. I'm holding my property for the next 20, 30, even 40 years, however long I've got. And I'm going to be buying that with a long-term view. So I'm not worried if it goes up 5% and then down 3% next year. I think at some point in the next 3 years, there will be a slight correction, but not a major correction. I think we're going to see some strong rental demand and rental increases. So what you might lose in a slight capital growth, I think will be more than made up for in the higher rental return that you're going to be getting by holding the property and getting into the market when you can. The other thing I'd say is that a lot of people, think, oh, I've got this pre-approval, I'll just buy when I'm ready. A lot of people don't realise their borrowing levels change over time, Ben, and I think use the borrowing capacity when you've got it. I think it's gold. So it's very important to get advice and use what you've got. Look, guys, I think we'll have to wrap it up there. Can I just say thank you very much, Ben, for your contribution and input. Thank you, John, for your help today in answering all the questions. And look, we do encourage you to reach out with any other questions you've got, and we will be sending around the information package as well. But we want to wish you all the best, and thank you so much for watching.
All right.
Bye for now.
Thank you. Bye-bye.